Hey guys, Whitney here. Welcome to today's boot camp. We are going to be going over the offering memorandum and the private placement memorandum in passive real estate. So we're going to be learning about what each of these things are, why it's important for you to understand, the differences between the two of them, but also kind of like what information is in them, and then how to actually decipher what information you're going to find in which document, because they work in tandem together. Now, if you haven't been to one of these boot camps before, I'm your host, Whitney Elkins Hutton. I'm the Director of Investor Education here at PassiveInvesting.com. And these are skills boot camps. So we're going to dive a little bit deeper than we can in the masterclass. So we will be going through a lot of this information over the course of the next hour. We will open up the floor for Q&A. If you have a question, be sure to go over to your Q&A box. Drop in your question. That's the best way to do that. It helps me, stay organized throughout the presentation. But also just, if you have a question at any point in time, don't hold on to it. Put it in there. That way we can make sure we can get all your questions answered. Now, I would love for you to go ahead and go over to that Q&A box, not the chat box, the Q&A box, and drop in where you are joining from. I want to make sure that you found that box. While you're doing that, again, my name is Whitney, and this is the whole reason why I invest in real estate. It's because of me and my crazy crew here. I want to have choice and freedom on how I spend my time, how I, make an impact in the world, even be location independent. Now, my story starts off in real estate in 2002 when I bought a house with a significant other and the relationship fell apart. And then fast forward 11 months later, I rehabbed that house, sold it, made a nice profit on the property, realized hadn't been paying for any of my expenses. And that's when I was bitten by the real estate bug. So I did several live-in flips and house hacks on my own, and then eventually with my husband, who's pictured here. And then we scaled up a 36 single-family rental portfolio, bought a 52-unit building with some other partners. I've been a general partner on over 10 projects, raised on over 29 private equity projects. And then we have a myriad of other businesses too that we either run ourselves or are an investor in. But all of these things, all these stats, is just really to produce a result, which is we have 100% control in how we, in choice, I should say, on how we spend our time. And we can actually help you do that, replicate those similar type of results here at PassiveInvesting.com. We have some really strong metrics that we produce for our investors. Now, I want to be really cognizant of the time here because we have a lot of information to go through, because I've done webinars individually over the offering memorandum, over the private placement memorandum, but I wanted to bring these two together so you understand where they're similar, where they're different, and then how they work together as your full due diligence package. Now, I love seeing here somebody actually did share where they're from, Atlanta, Georgia. Awesome. Drop in the chat box where you're joining from, because it helps me understand, a little bit, gives me a little bit insight about you and where you're from. All right, so let's dive into the offering memorandum. All right, so the offering memorandum, it's also known as the deck. It is the marketing deck, the pro forma. There's a lot of different names that it can be called, but the offering memorandum is a document that states the objectives, the risks, the terms of an investment. Now, it's pretty much a marketing document. Okay, so really, this is one of those things, when you get a deal, you need to trust but verify all that information. You need to trust but verify all the financials in there. Double check, trust but verify all the biographies of the team members, the operators that are listed in there, and also dive into the business plan. Okay, now that might seem a little overwhelming, but as you flex your muscle to learn how to read various offering memorandums, it will actually get easier to do this over time. Okay, so often it's the only document, this offering memorandum, is really generally the only document you probably get to see before you are placing some sort of commitment, whether it's a soft commitment or a hard commitment into a passive deal. Now, if you're placing a soft commitment, that means, you're probably about 85–90% sure you're going to invest, but if you find something, you're legally not bound to invest. If you're placing a hard commitment, with an operator that has that type of process, there's probably some sort of legal binding for you to invest. Now, while you could still pull out if you find something on your due diligence, hard commitments, there's generally kind of a strike rule that operator is probably operating under. For us here at PassiveInvesting.com, we have a soft commitment rule, but we try to give you as much information as we possibly can up front, so you can make an educated decision. Now, in this offering memorandum, it's going to have different sections, okay? Now, each offering memorandum is going to differ based on the operating group, the jurisdiction that they're operating from, maybe like Alaska versus Florida, right? Also, the different type of asset class, what is generally included for that particular asset class. But these are pretty much the big high-level sections you're going to find is the executive summary, the property profile, financial analysis, a market overview, and then you should see a portfolio and track record of the investment team. Now, this is, if you're looking at an offering memorandum, if you've done your due diligence in the right order, and using the term right is kind of subjective here, and that means you've already had a conversation with that operating group. Okay, so you've already done your due diligence on the operator. Now you're just vetting the market in the deal. Okay, so if you have an offering memorandum and you have not had a conversation with that operating group, make sure that that is one of the first things you do before moving forward. All right, so now that we understand what an offering memorandum is, okay, again, it's more of the marketing document that has the business plan in there, right? You're trusting but verifying the information. How does that differ from the PPM? Okay, the private placement memorandum. Now, the private placement memorandum is actually a set of legal documents that secure your place in the deal. Okay, now they're collectively called the private placement memorandum, but most people don't really realize that the private placement memorandum is actually one of those three documents. So what is this package? Okay, what are the three documents in there? Now, there's usually a subscription agreement. Okay, that's you outlining the number of shares in that company that you are purchasing. There's the operating agreement that's outlining how the operating LLC is going to work. And then there's a private placement memorandum, which goes through all the kind of the overarching business plan, all the risk associated, and really, again, giving you a lot of that clarity in detail. Now, here's kind of the kicker. Most operators that I have seen, when it comes to the business profile section of the private placement memorandum, they don't recreate the wheel. They'll just take the offering memorandum and stick it in the PPM. Okay. Now that's very cool because you've already seen the document. Okay. Ideally, hopefully there's been no changes. Also, it is another way for them to communicate the business plan. So it's really critical that you understand both of these documents in tandem. Okay. So the PPM is going to tell the potential investors all they need to know about the company, the investment, the nature of the business, and the potential risk of the investment. Okay. In the PPM is the subscription agreement. That is the agreement. When you sign that document, you're signing a legal contract between the company and the investor for them to issue you shares. Okay. So if you've ever signed a PPM and then you're just like, oh, well, I haven't wired my funds, I don't want to do the deal, I'm going to pull out. Just know that you actually signed a legal contract to fund your investment. All right. So just know that. These documents, the PPM, actually have to meet the requirements of securities regulators and are similar to prospectuses used for publicly traded issues. So if you're investing in stocks, bonds, and mutual fund annually, you probably get a little, mailer, that's really thin paper, printed in 4-point font and is about 20, 30 pages long, very thin. Okay, they want that to be thin. Those securities, they want that to be thin so it doesn't seem like there's much information in there and you feel good about it. But that's exactly the same type of information that's in a private placement memorandum. Okay. All right. So again, like I said, these documents work in tandem, but there's some stark differences here. So I want to put up this slide to help you compare contrast on if you're trying to do your due diligence and you're trying to find the information or get an answer to a question, where are you going to find that answer? So again, the offering memorandum, it's going to give you more the market overview, investment rationale, property details, and the strategy. It's going to give you comparable analyses for both sale and rental. Okay, this applies whether it is a business, whether it is a multifamily or self-storage, mobile home park. It's going to give you economic and demographic trend type data. There should be some sort of statement in there on the local or community impact of, whatever the business plan is for that particular asset. It's probably going to give you a visual representation of financials. It's going to outline what, over the course of the whole period, what is the future business plan. All right. And then, it'll give you various other additional investment highlights that the operator wants to share. Now, the private placement memorandum, again, like I said, is more the legal side of things. It's going to give you the legal disclosures and risk factors. It's going to apply or comply with securities law compliance. It's going to have a subscription agreement. There's probably going to be an investor questionnaire in there to qualify the investor. There's going to be the investor's rights and obligations are listed in there, any legal disclaimers. There's going to be regulatory filings and compliance, and then also legal contact information. Okay, like I said, these two documents work in tandem. All right. Now, I want to just kind of, again, we've already kind of helped you understand what each of these documents are, what is their role, how do they work together in a package. But if you're looking for specific data, which document you might want to look in. Let's just take a quick little purview of if you're looking for that data, what can you expect to find where? Let's deep dive a little bit more into this. And like I said, oftentimes you're looking at the offering memorandum as the only document that you're going to have prior to actually placing a commitment. So this is the document that is going to get you 85 to 90% there saying you want to invest. It might get you 100% there. You might be super excited, but you still must review the PPM. Now, let's talk about financials, because this is oftentimes what people want to learn, when they look at an offering memorandum. So in the offering memorandum, it should outline the cash-on-cash return, the internal rate of return, the annualized rate of return, the equity multiple. It should also tackle any preferred return that the operator is listing and any IRR hurdle or AKA splits that the operator has to achieve. Now, this is where we're going to get kind of just a little high cursory overview of math. If you have, have deeper questions around what each of these returns are on our passiveinvesting.com page under our knowledge base, I have done many videos to go deeper into each one of these return topics. But we'll just take a quick 30,000 foot walkthrough of what each of these different terms are. So cash on cash is going to be the annual dollar income return divided by your total equity invested. That's your cash on cash return. So if you're, and this can be different than the preferred return, right? Preferred return, we'll talk about that here in a second. But the cash on cash could be, if say you placed a $100,000 investment and in year one, your cash you're bringing in total annual cash flow is $6,000. Your cash on cash return is 6%. Okay. Now, internal rate of return is a little different. Okay, this is looking at the rate of return that you would make of the present value of future cash flows plus your final market value of the investment opportunity, equal to the current market price of the investment or opportunity. All right, the higher a project's internal rate of return, the more desirable a project probably is to undertake. All right, so this is when people say, explain to me internal rate of return. It's the calculus equation. So, but what I want you to understand here, the difference between internal rate of return and annualized rate of return is an annualized rate of return, there's no time taken into account for this. And here we are taking into account time. Okay, we have the return of capital and the return that you can anticipate. So internal rate of return is generally lower than your annualized return. Okay, the quicker you can get your capital back, generally the IRR will be higher. Okay. Now, annualized rate of return is a little bit different because we only account for the holding period up here in this exponent. Okay, it's not accounted for in the actual return of capital. All right, so an example that I use in the webinar that I do specifically between IRR and ARR is if I told you, if you gave me $100,000 and I'm going to give you $300,000 back, are you excited? Most people are like, heck yeah, I'm excited because you're going to 3x my money. But I didn't tell you how long I was holding the money. Okay, that is the difference between these two. All right, equity multiple. This is a pretty good measure to compare projects as long as the timeline is the same. Okay, as long if you're comparing two projects that are both 5-year hold times, equity multiple is a pretty good number to use. But if your hold times are different, say 1 5 and the other one a 10-year project, that's hard. That's very hard for you to use equity multiple. And then to compare projects, you're going to want to use internal rate of return. Okay. Now, equity multiple is the total cash distributions received from an investment divided by the total equity invested. Okay. Essentially, it's how much money an investor could make on their initial investment. All right. So if you give me $100,000 to invest over 5 years, if between cash flow and the capital upon sale, I give you $200,000 total, I have 2x your money. The multiple is 2x. Right. If I give you $300,000 in that 5-year period between cash flow and capital gains, I have 3x your money, or the equity multiple is 3x. All right. Now, that's a really great deal. I have not seen many 3x deals in real estate lately. But anyways, again, you have to make sure when you're comparing projects that the timeline is the same. All right. Preferred rate of return. This is often called the pref, okay? The pref describes the claim on profits given to the preferred investors in a project. The preferred investors will be the first to receive returns up to a certain percentage. So a lot of the prefs that we offer on our multifamily and self-storage deals historically have been a 7 pref deal. That means the first 7% goes to the investor. Okay, they get that return before we start sharing in profits with them. Okay, so you can actually think of it as a hurdle for the general partner to achieve. Once they've achieved that hurdle, then the general partner can actually start splitting money with the investor. All right, and like historically on our express car wash deals, our pref has been 10%. Now, the pref can work on based on cash flow and equity. So here's a typical stack that you might find in our offering memorandum. Okay, we have the capital stack here. How much debt's being acquired? How much is the limited partner bringing? How much is how much between the general partner and limited partner are they bringing? And what is their percentage ownership? Okay. Now, here in the partnership structure, that's different. We call this the waterfall. This is where, who gets what money when. All right. So in this case, on cash flow, in this particular deal, it was a 7% preferred return to the investor. Once that was achieved, and then the general partner gets to split 70-30 thereafter. Now, when the asset goes to sell, okay, the general partner, as long as the profit will be met first, once the pref is met, then the next hurdle is the general partner would split 70-30 until they hit 13% IRR. Once that hurdle is hit, then the general partner gets to split 50-50. Okay. And all these deals are different, but I just want to make sure that, you know, in the context of today's webinar, it's not so much about understanding the different types of returns and the numbers. We have additional education materials to help you focus on that. But more so, these are the terms that you should be looking for in the offering memorandum, okay? And not only understanding them, seeing these visuals, but also locating them in the private placement memorandum to make sure whatever's listed in the offering memorandum matches the private placement memorandum, okay? Now, I want to go over one more thing before we kind of open up the, you know, go through the PPM and then open up the floor for questions. And that is the sensitivity analysis. We also, in the offering memorandum, you should locate something like this when you're reviewing returns. And a sensitivity analysis really gives you a clue of, has the operator thought through different scenarios? If the market should go up, okay, get better, go down, get worse. Have they thought through different net operating income situations? Have they thought through different cap rate situations? And what would the potential numbers be? Now, here's the thing. A sensitivity analysis, we're going to have our next boot camp. We're going to dive into just the sensitivity analysis with our director of acquisitions, because I think it's so important for our investors to truly understand, especially in today's market environment. This is where the operator, a really great operator, will put out a great sensitivity analysis. A questionable operator who is kind of you know, hoping that their strategy works might put out one that is like with rose-colored glasses, because you can manipulate the sensitivity analysis. All right, so this is where the operator is so very important. You want to be with a very reputable group, okay? All right. Now, how to read a PPM, you know, there's another video where I go through and I tour the different sections of the PPM. I even show you how to fill out various sections. So we're going to kind of set that aside for right now on the actual physical tour, but I want you to make sure that you're looking at a few things when you're studying the PPM before you sign it. So again, you know, a lot of people, you know, when they first start getting into a private equity deal, they're like, oh, there's so much paperwork. I don't want to do this. My stocks, bonds, and mutual funds are so much more easier to invest in. Why is that? Well, you actually get that prospectus ahead of time, and everybody expects that you read it. And actually, it's not any longer than a private placement memorandum. But how many people actually read it? I know when I was investing in the stock market, I wasn't reading the prospectuses. Okay, here I think it's actually a little bit. I don't. Safer is kind of probably the wrong word to use here, but a little bit more transparent. That, you know, we put it in a font that you can actually read. For one, it's not in 4-point font. You don't need a magnifying glass. But two, it is something that you are signing. You know, physically signing that you have in multiple places, that you have reviewed each one of those sections. So I think there's a lot more transparency in private equity real estate. But when you're vetting this, again, you want to get pretty comfortable at reading a PPM. All right, okay, because that PPM, it's that document that it's going to go over the general partners who are operating the deal, the location, and the number of units. And I want to back up just a little bit. This is kind of my checklist to make sure what I'm seeing in the offering memorandum matches what's in the PPM. Okay, the general partners who are operating the deal, the location of the deal, and the number of units. Okay, the deal structure, the returns. I want to make sure that capital stack is the same. I want to make sure the waterfall listed in the offering memorandum and the PPM are the same. I want to make sure any fees that have been disclosed to me are actually listed in the PPM, and that the distribution timeline and frequency are in there. All right. Also, when you're considering the PPM, you need to consider how you want to title and fund your asset. Okay, so this is a little bit beyond completing due diligence on the PPM, but this is something that you want to consider because it might matter which pages of the PPM you actually sign, review and sign. So no operator should be advising their investors on how to title or how to fund. Okay, that should not be happening. But based on what your goals are, we might be able to, kind of like point you in the right direction with information. But ultimately, this is a decision that you need to make for yourself, or you can go to your tax or legal team to make this decision. But here's kind of some broad strokes here. And again, double check this with your team. If you're, investing as an individual, if it's just yourself investing, you could possibly do it as an individual. If you're investing with a spouse, okay, you guys are probably going to sign the document together. Okay, based in even if you're an individual, if you're in a communal state, you might have to sign as joint tenants. If you're investing as an entity, okay, like a trust or a business or a retirement account, then you're going to be filling out the document as an entity, not as an individual or a joint. And if you're using your SDRA or your qualified retirement plan, that you're going to be using a separate section of documents to invest as a retirement plan. Okay, why is it important to really dial in at the very beginning how you want to invest, okay, and title this properly and fund it properly? Because these questions that you would ask yourself, it would have impact where the cash flow goes, where the equity goes, how the tax benefits are being utilized, and how this impacts your tax return. It might actually impact how you transfer assets should something happen to you, or how your assets are shielded from creditors and predators. All right, guys, we're going to open up the floor to Q&A and dial in a lot of your questions. So if you're here live, jump on over to the Q&A box. I will do my best to answer all those questions. If you are watching this after the fact, this is your invitation to join us for future webinars at passiveinvestingwithwhitney.com. If we haven't already jumped on the phone with you, I would love to get to know you better, understand your goals, and how we can help you here at passiveinvesting.com meet those goals. And you also get priority access to our future deals.